When global markets panic, headlines focus on stock crashes. They focus on bank failures. They focus on emergency rate cuts. But there's another rescue tool rarely discussed. It doesn't require congressional votes. It doesn't trigger public debate. It operates quietly between central banks. It moves trillions across borders. And most citizens never hear about it. It's called a swap line. To understand swap lines, we must understand the dollar. The US dollar is the world's reserve currency. Global trade is priced in dollars. Oil is traded in dollars. International debt is issued in dollars. Banks outside America borrow in dollars daily. Corporations hold dollar liabilities worldwide. This creates dependence, a global hunger for dollar liquidity. And hunger becomes dangerous during crises. Swap lines began in the 1960s. The Bretton Woods system was under strain. Currencies were pegged to the dollar. The dollar was tied to gold. Speculation threatened exchange rates. Central banks needed coordination. The Federal Reserve created temporary currency swaps. They exchanged dollars for foreign currency. The goal was stability. The mechanism was quiet. For decades, swap lines remained limited. Then came 2008. The global financial system froze. Banks outside the US desperately needed dollars. European banks had borrowed heavily in dollar markets. When credit collapsed, dollar funding evaporated. Without dollars, foreign banks faced failure. This wasn't just a European problem, it threatened global contagion. The Federal Reserve stepped in. Swap lines expanded dramatically. The Fed provided hundreds of billions in dollar liquidity. Central banks in Europe and Asia accessed funds. They lent those dollars to their domestic banks. Liquidity returned. Panic eased. But few citizens understood what happened. No direct taxpayer vote occurred. No global referendum was held. The plumbing of finance was repaired quietly. Here's the mechanism. The Federal Reserve exchanges dollars for foreign currency with another central bank. The exchange rate is fixed at the time of the swap. The foreign central bank then lends dollars to banks in its jurisdiction. At maturity, the currencies are swapped back. Interest is paid. Technically, risk appears limited. Politically, visibility is minimal. But strategically, power expands because dollar liquidity becomes centralized. After 2008, swap lines became semi-permanent with key allies. The European Central Bank gained standing access. So did the Bank of Japan. During the pandemic in 2020, swap lines surged again. Global markets panicked. Dollar demand spiked. The Fed reopened and expanded facilities. Billions flowed overseas. Stability returned once more. The pattern repeated. Why does this keep happening? Because global finance relies heavily on dollar funding. Foreign banks hold trillions in dollar-denominated assets and liabilities. When stress rises, dollar funding tightens. Markets scramble. Swap lines patch the gap, but they don't remove the dependence. They reinforce it. Each crisis strengthens the dollar's central role and strengthens the Federal Reserve's global influence. The Federal Reserve is a US institution, yet its swap lines affect global markets. Liquidity decisions ripple worldwide. This is monetary power beyond borders. No international parliament governs it. Coordination happens among central bankers. Transparency exists, but rarely public understanding. Crisis after crisis confirms the same structure. Global banks depend on dollar access, and swap lines ensure survival when stress erupts.